Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Last month marked the end of 140 years of coal-powered electricity generation in the UK with the closure of the Radcliffe-on-Soar power station, making the country the first G7 nation to stop using coal to generate electricity. But needless to say, there's still a long way to go in the transition to clean power sources, and this week we are looking at the company that's at the centre of it all. That's National Grid. With electricity demand predicted to double over the next 25 years, the company announced a £60 billion investment plan this summer, as well as a rights issue and a rebased dividend. Jemma Slingo is here to discuss what it means for the business and for its many income investors, as is Newman. Of course, the energy transition will affect many others too. Our Result of the Week segment examines car dealer Vertu Motors, which has been holding relatively firm amid car makers' struggles to deal with falling demand and increased competition from Chinese EV manufacturers. And we're also going to be talking about the issue that's irritating both advocates for and critics of investment trusts. That issue being cost disclosures. Last month, trust campaigners won a breakthrough after the government said European rules need no longer apply. But it now looks like the retail platforms may not play ball. McKechnie will be here to talk through the ins and outs of that later on. We're going to start, though, with National Grid. Jemma, I won't ask for your views on a Radcliffe-on-Soar power station, which is close to my heart, having driven past it many times in my youth. Let's talk about the company, the transformation plans. What do they involve? And maybe we can set the context for people who don't know, because we all know of National Grid, but maybe some people don't know about the company, the investment case, how it operates as well.
Yeah, so I'll start with the transformation plan, if that makes sense. First and foremost, it involves a huge amount of money. So, as you said, they've pledged £60 billion over the next 5 years, which they'll be investing in the grid, both in England and Wales and also in the United States, but we'll probably come to that later because that confuses things slightly. But basically, the grid needs a huge amount of investment, both to reinforce it and to expand it. So, as you mentioned in the intro, demand for electricity is only expected to go up, and it's expected to go up pretty quickly. So the grid needs to be reinforced in order to cater to that demand. But I think the less obvious side of things is that as we move more towards renewable energy, where the cables actually need to be is different. So where you generate renewable energy tends to be offshore, often in the North Sea, and that's very different to where it's historically been made. So the grid actually needs to be extended in order to connect up all those dots and keep being able to feed power to where people are actually based. And at the moment, that's just not happening, because when I was doing the research, I found out basically in the moment we're having to pay wind farms in the far north to stop generating power and pay power stations closer to where everyone lives to generate power, because we have these bottlenecks in the grid. And obviously that's hugely inefficient and very expensive for consumers. So they're hoping to tackle some of those things.
Yeah, there are these counterintuitive things at play, aren't there? Battery manufacturers have also been complaining in recent months, haven't they? Because their whole rationale is to step in sometimes when other energy sources can't provide the energy, when the wind isn't blowing and the sun isn't shining, etc. But National Grid's own systems there struggle sometimes to tap them, and they've therefore been going back to, well, in recent months, coal generation, things like that, gas generation more so than batteries. So there's lots of little kinks, and clearly it's not a one-way street to just shift everything over to renewable power and then we're done. Why don't we talk about how National Grid makes its money, though, as well? Because it's raising $60 billion for all this investment. It is constrained, though, by Ofgem rules, effectively, as to how much money it can make, and there might be some changes there as well in the months ahead.
Yeah, so on one level, it's very straightforward how National Grid makes money. Basically, when you get your electricity bill, there'll be a small charge for transmission, which is the shifting round of power around the country in the massive pylons that you see. And that's typically pretty cheap. So it's about £20 a year each one of us pays for transmission. And National Grid also deals with a bit of distribution, which is essentially moving electricity at a lower voltage from the grid to our homes or to businesses. And again, there's a relatively small charge for that. So that's how it makes its money. We pay for it. But Ofgem, the regulator, basically sets how much it's allowed to make. And there are a huge number of very complicated diagrams, which I discovered. But the basic principle is pretty simple. So it sets an allowed rate of return and multiplies that against the size of National Grid's asset base. So the bigger National Grid's asset base, the more money it can effectively make. And that's why a lot of people have got very excited about this massive investment plan, because it will hugely expand the scope of its assets, which should hopefully accelerate growth in the future.
And Ofgem has made some positive noises as well, because as with other utilities, there are 5-year or multi-year cycles. There's a new 5-year regulatory cycle coming up for National Grid, and Ofgem has made noises about allowing them to make a little bit more in recognition of the fact that all this investment needs to take place if we're to change to renewable power.
Exactly. I mean, there's always a load of wrangling, I think, just before that regulatory period kicks off. But there definitely seems to have been a shift from purely focusing on the cost to consumers and keeping everything low to the acknowledgement that actually we're going to have to spend money in order to set up the country. So costs aren't everything. It needs to be an investable proposition as well. And it did actually include that term last year for the first time, investability, when it was thinking about what rate of return National Grid should be able to make.
Of course, there are all these attractions in the future, potentially, if it can sort out various connectivity issues, and planning issues are involved in this as well, of course, which is a whole other discussion. At the same time, though, as we've said, the investment plan did also involve a rights issue and a dividend rebase, if you want to call it a rebase rather than a cut. Can we talk first of all about maybe some of the things shareholders need to watch out for in terms of forecasts in future in light of the rights issue, and then maybe move on to the question of whether National Grid is a growth or an income stock, if you can put it in that binary, because clearly it's been relied on for income for a long time as a fairly stable business, but now it's very much investing for the future and changing a little bit.
Yeah, so I won't bombard listeners with a load of different numbers, but I think the thing to remember with the rights issue is that obviously it hugely increased the share count. So when you're looking at profits from a total perspective, if you're looking at operating profits, the growth looks great. But then when you're looking at an earnings per share metric, actually things start to look a bit more muted. And I was chatting to a couple of analysts for the piece, and they mentioned, you need to be careful what year you're starting from, basically, when you're measuring the growth, in order to see what impact that rights issue has had. So that's one thing to think about. And also, obviously, as you say, the dividend's been rebased, which is obviously important for people who are thinking of it as an income stock. I must admit, the people I spoke to didn't seem massively concerned about the dividend. So it's inflation linked, and they think that could still continue nicely. It's historically been very, very solid, and it's got great visibility because they've announced this plan now, and Ofgem seems supportive of it. So I think the dividend looks secure, but we will have to see.
Yeah, there was some expectation, I think, that something was maybe going to change. I don't think there was necessarily the expectation of the rights issue, but for those people looking at it afresh, they are at least through that now. Alex, let me bring you in here. What are your thoughts on National Grid and all the challenges and opportunities it faces in future?
Well, yeah, I mean, very complicated company in many ways, as Gemma's outlined in the way it makes its money. But I suppose how investors will approach this company is, I think it's interesting to set it up as the dichotomy, as we often do, between, is it an income stock? Is it a growth stock? Is it a quality stock? In a way, I think you could say yes to all of these questions. I mean, we've got quite used to growth as something that, from the tech sector, that can be very, very capital light. And also, capital intensive sectors like banking or resources either aren't sufficiently reliable in their earnings visibility or have been disintermediated, that we don't really think of capital intensity as a sort of byword for growth. But the kind of growth that National Grid is plugged into is the sort of thing that thematic ETFs are built on. It's a really long-term trend. It's not got the kind of competition that other big themes, I suppose, see. So it has this, almost kind of quasi-monopoly position in some of the markets it operates in. And, when you look back at National Grid to its kind of various forms over the last 30 years, it has been a really, really consistent performer. So that the points on, I suppose, the reliability of earnings are really quite well founded in its track record. So this kind of total return per annum has quite consistently averaged kind of 10 to 11 to 12% over the last 30 years. It's kind of stepped up in the last couple of years. Maybe that's because investors have reset their expectations and are thinking a bit more bullishly about the way this company answers many of the things investors are looking to do with their capital long term. So that's something to consider. But yeah, I mean, it's not often we talk about what, maybe this is my kind of personal take, but it's not often we talk about UK companies, as really sort of exciting growth stories. And, this isn't going to be growth in the way that, we sort of see with Nvidia, for example, but it's a very, very solid long-term buy and hold story with like a great dividend and solving some big challenges that we want businesses to solve. I'm kind of quite a big fan, albeit with the caveat that these highly complicated companies have things that do go wrong, and regulation is always a sticking point. But yeah, I think it's a great vote of confidence in the market that that from the market that they're able to raise so much this year, which is a good long term thing that investors would like to see as well.
Yeah, and there wasn't, I mean, clearly there was a bit of a drop to begin with and dilution taken into account from the rights issue, but the share price hasn't unduly suffered from that either, which speaks to, I think, that confidence. Let's talk about the US side of the business, which you mentioned briefly at the top there, Jemma, because that is still quite a significant part of the business as well and works in a slightly different way, as you'd expect, to the Ofgem regulated aspects.
Yeah, it's a really pesky thing about National Grid because you talk for ages and ages about England and Wales, and then you just throw in that actually 40% of its operating profit does actually come from the US.
Yeah.
So from mainly New York and Massachusetts. I think a lot of the drivers of growth are quite similar because obviously in America they're also having to expand the grid. But it's worth noting that National Grid has a lot of gas assets as well in the US, which does change the dynamic a little bit. And one analyst was saying he thought long term, maybe that wasn't quite as sustainable as the electricity grid, and National Grid might be tempted to sell it off to raise a bit more cash. It's also worth saying that the regulatory system in the US is quite different to in the UK. It's much more fragmented, seems more ad hoc in terms of when sort of what National Grid's allowed to make is all a bit up in the air, and then it takes a long time to push through. So there can be these lags in its returns. But it is an important part of the business, obviously, and at the moment does seem to be enjoying similar momentum to over here.
And that speaks to the valuation case for the company, which Alex has just discussed some of that, but valuing that US business and the UK business, they seem to be trading at reasonable levels at the moment.
Yeah, so a few analysts seem to take a sum of the parts approach. So they looked at the network over in the UK and over at the Atlantic and concluded that both of them should be trading at premiums given they've got these great growth opportunities. From a price to earnings perspective, it looks all right as well. So it's traded on a 5-year average of about 15 times and it's now on about 14 times. So roughly in line, but obviously we've got this really good visibility and this established growth strategy now. So people are probably feeling a bit more confident than they were before.
It's kind of a question of the premium to put on the regulated asset base as well, isn't it?
And, that is very tricky because also I did raise the point with a few of my interviewees, like, is it guaranteed that this investment plan will actually play out? Because obviously it's hugely complicated arranging all these projects and there is a labour shortage at the moment. So actually having the skilled technicians to be able to pull it all off might prove difficult in the next 5 years. So that's a potential sort of pothole further down the line.
Yeah, but for now, it has the money, it has the plan. We'll see how it goes. That is our cover story this week. We do also go into a number of other related companies involved in cables and involved in various parts of the grid and related sectors, but we shall pass over those for now and save those for people looking at the magazine or looking online at the article. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. We're going to talk about car manufacturers now. Mark Robinson, I failed to introduce you at the top of the show, but I know you're here to
I am here.
talk about Vertu's recent results out the other day. What did you make of them? Because as we've said, it's a tough time clearly for automakers themselves. There's been a lot of profit warnings there in recent weeks, certainly in Europe. But Vertu's making a good fist of it at the moment.
Yeah, I guess you could say it's a case of relative outperformance. There aren't that many listed auto dealers anymore, but
Mm.
relative to the market as a whole, its sales figures haven't been that bad. We we commented on the latest figures from the Society of Motor Manufacturers and Traders in the article, and we also cited recent comments from the chief executive of BMW, which point to the erratic nature of the sector at the moment. It's something that we've covered in depth many times over the last 18 months or so. The main worry continues to be private sales into the market. Fleet sales have held up reasonably well, but that's expected really because there's a sort of cyclical nature to those fleet operations. Vertu delivered an increase in revenue, which was broadly in line with the increase in inflation. So there's sort of flatlining in that regard. Core group gross profit was up during the period, and they made great store of the fact that their NAV increased over the period too. So in relative terms, yeah, I guess you could say that they're making progress as well. You certainly get the impression when you speak to management is that they see the slump in the market, and we might say it's the mandated slump in the market as an opportunity, and that's why they've kept on spending in parts of the business which are driving underlying profitability as well. I'm thinking here mainly of the digital aspects.
Yeah, we'll come to those aspects in a minute, but why don't we talk a bit about what Vertu are reporting on the new versus the used car side of things? Because in recent years, ever since the pandemic, really, there's been quite a big split there in terms of activity and in terms of pricing strength, and that is still the case. There was a bit of a slowdown or correction in the used car market last year, but it still seems fairly healthy, whereas the overall lack of demand is really weighing on the new car market. Is that fair?
Yeah, that's exactly right. I mean, the outlook for the used car market it's still pretty strong for the rest of this year, although there has been some industry concerns over stock shortages and general customer confidence. But the fact that it's still relatively lower cost and there's reduced risk will sort of support demand over the period. There was some speculation in the press today that Rachel Reeves is under pressure to increase the tax rates for new vehicles as well, but I'm not quite sure what difference that would make in terms of the take up of electric vehicles. I think that would just be supportive of the used car market again going forward too. Prices have come down a little bit because you did have that surge, post-pandemic surge in prices for used cars, and that was also a sort of a knock-on effect of the problems we had of used new car supplies too,
Mm.
because of the semiconductor shortage and so on. So yeah, things haven't changed that much. I guess I've often taken the view that the main thing that government could do to try and stabilize these markets at the moment would be to change the medium term mandates away from pure electric vehicle use through to hybrid. I think that would stabilize both the new and used car markets to a certain extent.
Yeah. Well, Vertu says it has been taking, for what it's worth, in a falling market, it's been taking market share in these areas, certainly in the new market, I think it said, and the electric vehicle side of things too. We'll come to that digitization aspect, as I say. But I'm just going to bring Alex in again, because this is a market, or certainly the listed market, as we've alluded to, has changed quite a bit in recent years. A lot of companies been taken out. What do you make of it? And Vertu is a relatively small player, but one of the last ones standing from a listed company perspective.
Yeah, so we had the takeovers of Marshall Motors, I think, and Lookers And then there've been disposals of the UK retail arms by Inchcape and Pendragon. So I think there's an AIM-listed dealership called Caffins, which is a bit of a minnow, but Vertu is kind of the last man standing in the listed space. Why companies would look to sell themselves to a buyer or look to get rid of their dealership arms, quite straightforward. I think the economics of dealerships at kind of subscale are pretty horrible. So one metric we sometimes look at with retailers is price to sales. You look at a company like Vertu, they have a price to sales ratio of 0.04 times, which is kind of a meaningless measure. So, and that is a reflection that their net margin is basically it is less than 1%. So they I think they're on course to sell about £5 billion in sales this year. And from that, they eke out a very, very, very small profit at the end of the day. So, is the company, is it cheap? Yes, but it's cheap for a couple of reasons. One being that super thin margin, and two, just like the inconsistency of earnings. One of the reasons why there was quite a lot of excitement about this sector coming out of the pandemic was because the reasons Mark mentioned about constrained supply, prices were rising. There was huge demand for cars that was sort of compressed demand into kind of 18-month period. If you look more broadly at the kind of the entire listed history of Vertu, that's really been the only period where they've had real momentum in the business, and it's kind of since fallen back. So if you're a scale player, the kind of companies that have bought into this sector or taken over, then there are definite synergies here to getting bigger, tacking on after sales and making a kind of big brand dealership model. Subscale, it's quite hard to make it work. Try as hard as Vertu has. So yeah, I mean, I'd say the one big hope here, aside from if they are going to make grand pushes into after sales and digitalization, which maybe we can come on to, is that they get acquired by someone. And there is a bit of hope there, as we also might come on to, given their share holding.
Yeah, they have a shareholder with a 10% stake, don't they? Is the owner of Constellation, I think, which is the company which took Marshall Motor private a couple of years ago, the private equity group. So clearly there's
EDR, I think, yeah.
Yeah, so there is some interest there. Let's talk about the aftermarket, though, because they do like to talk about that. And Mark, you looked at that as well, the after sales division. Clearly that's an attempt, as Alex was saying, to boost margins. I mean, they're never going to be spectacular, but there's an attempt to drive more profitability through that. Well, what kind of things are they looking at there, and in terms of digital services too?
Yeah, fairly straightforward in many respects, but I think it ties in with a lot of companies that do pursue after sales service as a way to generate revenues. So it's just a question of convenience for the customers as well. They've got schemes they've put in place, like deferred payment options in the service area. If you're looking to book in your car for service or repairs, it's just a question of going onto your phone now and getting appointments that way. Likewise, when things are finished, it comes back through to you as well. And about 3 out of every 5 customers now take this option with the company. And it's just a question of driving in and sticking your keys in the in-store kiosks there. There's also internal savings that are being made through an automated transfer of used car stock vehicles between the different dealerships. And that includes the transfer of accounting records and any supporting documentation. So it's just efficiencies across the board. I think sometimes we tend to forget that these type of dealerships have fairly hefty sort of back office costs as well. So it's not surprising in a sense that they're focusing on this area of the business too.
Yeah, it seems, I think, logical, the things they're doing. As you say, they're converting to one brand, aren't they, this year, in an effort to perhaps cut some of those costs and clearly boost the brand identity, because they still have the Bristol Motors brand, I think it is, and a couple of others in there as well. Why don't we finish by looking at the valuation, because Mark, I think you're relatively positive on it. Is it fair to say that in the context of clearly a market that is struggling and may well struggle for a while in terms of overall car demand, there is potentially some attraction there? I know Alex has maybe set out the bear case, but what are your thoughts?
Well, I just thought that the forward rating of about 7.5 times forecast earnings it isn't extravagant when you look at an implied dividend yield with it as well, which is just over 4%. So it actually wouldn't take that long for you to get back the principal of your investment. That said, Alex's points about the margins are on the money. So that's a risk factor there. But then again, if you've got someone like TDR Capital lurking in the wings as well, that could be an avenue to a short-term profit on your investment. TDR Capital as well had a stake in a fairly hefty stake in Lookers at one point as well, but they eventually got out of that. I think they had a 20% stake, and so they eventually got out of the way to let that deal go through. So yeah, I guess it's not an extravagant ask. That's what I'd say.
Mm. Well, on that note, we're going to move on to our final section, which is another complicated topic: the issue of investment trust costs, and specifically how those costs are stated. Because, as we'll get on to, there can be some huge variations, which has caused a lot of angst in the sector. But there was a sign of light last month, seemingly, not just a sign of light, an entire sunbeam, because, as we said at the top, the Treasury, the FCA have said that these rules requiring these gigantic costs to be displayed would no longer apply. Holly, can you sort of outline that in a bit more detail, and then we'll go on to what the platforms are saying as well, and putting a bit of a spanner in the works there.
Yeah, of course. So in September, the Treasury announced that it was going to replace the inherited EU regulatory regime with a new framework for consumer composite investments. And then they published some draft regulation on this on the 10th of October. So alongside the Treasury statement, the FCA announced a forbearance period on the previous regulations until the new regulations came into effect. And practically, this meant that investment trusts now have the option to reduce their stated ongoing charges to zero. And a big criticism of the previous regulatory regime was that under it, investment trusts had to essentially double count costs. So they had to include their corporate costs, such as managing the assets and financing, alongside their investment management charges. This meant that investment trusts tended to look disproportionately expensive compared with open-ended funds. And advocates of closed-ended funds have argued that the knock-on effect of this has been a decrease in the popularity of investment trusts, so among wealth managers and the like, and this has exacerbated discounts in the sector.
We should say, I suppose, as well, that none of these changes actually affect what people are paying, but it's that the disclosure is important because of those professional investors who are big buyers of investment trusts, or have been, because they need to disclose their own charges to clients. And in some cases, these trusts, with the double counting of costs, that includes things like finance, borrowing costs as well. So that can add 5 percentage points to your charge. And some trusts then had to say their stated charge was 8%. And then the people buying them would then have to explain to their own investors why their products were so expensive, even though the charges hadn't actually changed. And they thought, rather than do that, I'm just not going to buy an investment trust. So you got a lot of campaigners, including our own John Barron, trying to get this changed. Clearly, that has now happened. But the platforms think, don't they? It's swung too far in the opposite direction, because the idea is now you don't need to comply with these PRIPS rules, the European rules. Therefore, investment trusts are effectively just like shares, and all the costs are assumed in the share price. So the actual stated cost is zero, which, as we'll come on to in a minute, maybe isn't quite the case, and maybe there should be a middle ground. But what have some platforms said so far? It seems like they're maybe not quite committing either way, but they're also a bit wary of implying that there's no cost at all to these products.
Yeah, so there's been a bit of a mixed response from the platforms. Some have been quite hesitant about changing their current approach because they're concerned that it sort of misleads customers if you say the ongoing charge is zero. However, other platforms have been quite supportive of the new measures. So some major platforms like Best Invest and Hargreaves Lansdown have said that they're going to continue with sort of the old way of doing things for now. AJ Bell have said that they're going to actively monitor the situation. But then you've got Fidelity, who've come out and said that they're supportive of the Treasury's position and the FCA's forbearance measures. And they've actually gone out and contacted the investment trust on their platform to see what their position is and whether or not they want to update themselves on the platform. So the other side of this for platforms is that they've got this pre-existing process to collect the data for the investment trust and how they display it on the platform itself. And until they know what the sort of final legislation will be, they don't necessarily want to have to update those processes and procedures because it takes a while to get those in place for something that might then look quite different when we see the new legislation come into place in the next half of 2025.
And I think platforms clearly have got one eye on consumer duty rules as well, which have already caused them to take a bit more of an active approach to some funds that they don't think offer good value. I think they're wary of, yes, the crux of the issue is that the trusts say because the charges are effectively included in the share price, they should be able to say the charges are zero, as we've said. But if you think about it, really, I mean, the unit price of a fund effectively includes charges as well. That doesn't mean those charges don't exist. To me, it would seem the obvious solution. Well, I say obvious. There must be some issues with it because otherwise people would have done it, is to just state the management charge, because the fact is both open-ended funds and investment trusts do have a management charge that goes to the people running the company, running the fund. And investors have to pay that, whether it looks like they're paying it or not, that's there. But clearly there are some issues to be worked through. I mean, what are the AIC saying, the Association of Investment Companies, the trade body, who again have been very vocal about getting some of these really elevated charges removed? What are they saying about how they're going to work through this latest issue?
So on the whole, they're very supportive of this. They've, as you said, they've campaigned for a long time on this issue, so that they are pleased that some action has been taken. They're taking the stance that having the advertising zero ongoing charges won't mislead retail investors, but they have suggested that investment trusts will need to provide some context for that switch so people aren't suddenly seeing this big change and not sort of understanding why that's coming into effect. So they've suggested that investment trusts will have to continue to produce a modified key investors information document because platforms will require sight of these as sort of part of their sales process anyway. And they've also suggested that investment trusts might want to put some more bespoke disclosures in their fact sheets just to provide investors with that extra information about how those costs work out.
Which is probably admirable thinking, but I imagine the number of investors who read through these things closely is fairly slim. Ultimately, there is going to be confusion if something which was, say, charging 8% is now charging nothing, or optically looks like it is. But as we all know, price doesn't indicate value anyway. So who knows? Perhaps people will just look beyond this and realize that nothing has actually changed. There should just be a big sign, I think, at the top of the fact sheet saying no charges have changed despite all these stated changes over the past 3 years. And we just have to hope people take them on their word. I don't know. Anyway, it's clearly quite a knotty issue, isn't it? And I think there's going to be a bit more toing and froing between platforms and investment trusts by the looks of it. This does suggest it's not a silver bullet for the trust sector, but then I think it's fair to say there are bigger issues weighing on trusts and their discounts than just charges anyway. So we can hope for some improvement there due to falling interest rates and who knows, perhaps increased interest from wealth managers over time as well. That, though, is the end of the show. We have come to the end. We have run out of time. Thank you very much to Holly, to Mark, to Jemma, to Alex, and to our producer, Maddie Apthorpe. And thanks to you for listening. We'll be back next time